Hey everybody, welcome back. And it is our weekly show. We've got a guest star, Dan Golden, who's going to be on with us today. And because of that, I had to change the venue. Here's the funny thing. We're going to break the show up into a couple of different pieces. The first one, if you're struggling to understand what the heck is going on with mortgage rates, why when the feds drop their rate, why have been mortgage rates been consistently going up? And that is going to be the main topic for today. That'll be the first half of the show. The second half, we're going to go through all of the metrics and whatnot. And so we will have two different sections to this. So hang on and well, let's get to it. All right. So with that, let's bring Dan on. Welcome, Dan. How are you doing today?
Doing well. Thanks, George. Good to see you.
On. So here's the funny thing. You and I, we both get the call, oh my gosh, rates came down, it's amazing. And we were just talking about a call that you had. Tell us a little bit about your call yesterday.
Yeah. So, everyone sees the news and about the rates dropping. The Fed dropped the rate a quarter, which is true. They did drop the rate a quarter. They dropped it to between 4 and 4.5% on the bank rate. And so it's funny, I get these calls from people like, hey, I heard the rates are down to 4.5%. That's awesome. Let's go. And the problem with that is that the banks like to make a profit when they do a loan. And so they add about 3%, sometimes 2.75 to 3% to that number. So that's why the bank rate is now at 4%. Add 3, you're in the high sixes. 6.75, 6.7 to 7%, depending on the scenario. So that's the real rate. So I had to deliver that bad news, but.
Yeah. So it's super funny because a lot of folks, they get confused and they think that the feds actually dictate what mortgage interest rates are.
Right.
And as you and I both know, each and every week, that's not the case at all. And right. So because they hear it from me every single day, it's like hearing the other, they hear the parent from down the street say the same thing, then it becomes gospel. So what do the Fed rates actually control?
The Fed rate is the rate that the banks borrow money from the government, basically. So the banks borrow money from the government and then they turn around and lend it out to consumers. And then they make that 2.5 to 3% profit. But the Fed rate is typically going to have a direct effect on your home equity lines. So if you have a home equity line of credit on your house and you're at, the prime, and that's typically the prime rate at, 8% or something like that, 8.25. And when that rate goes down, that rate will go down as well as car loans. Like if you go out and buy a car before the end of the year, you're going to get a little bit better rate after this drop. And credit cards, your credit card rates. But mortgage rates are based on mortgage-backed securities, supply and demand. And the real indicator for mortgage rates is inflation. So if you watch inflation really closely, you'll see it tracks right with the mortgage rates. And unfortunately, it also has to do with what the Fed just says in their meeting. So the Fed said, yeah, we're dropping the rate a quarter, but then they said, but by the way, and that quarter is already built in because everybody expected it. So if it dropped a week prior in the mortgage banks, mortgage rates. So then they drop it, but then they start talking and they say, but you know what? We're not going to drop them as aggressively as we said we were going to. And someone was like, oh great, here we go. So then the mortgage rates go up. And then also they talk about inflation.
Yeah, which is what happened this time.
Yes, exactly. But yesterday we had some good news, which is another indicator of inflation was actually more positive and better than expected. So now I believe you'll see a little bit of a turnaround on the rates. They'll start inching back down a little bit. So they kind of knee-jerked up. I think they'll inch down, hopefully.
Right. Mm-hmm. And I agree 100% with you on that. It's interesting that, most folks truly think when they see the Fed rate, they don't fully realize that the Feds do not control long-term mortgage rates. They can affect it, as we have seen. In fact, if we pull up this chart right here, whoop, not that one. Oh yeah. Oh, how come I took that off? There we go. Mortgage versus Fed rate, right? So the dips that you see, that's when we hit our lows, and then that's also when the Feds reduce the rate, the half a point rate on that really big dip, because we were at 6.02, and then boom, immediately it went up, and then of course rates start coming back down. Feds reduce their rate again, boom, it goes back up again. We don't have enough, bandwidth on the calendar to show, hey, here it is, it went in, and then it'll start coming back down again, which is the prediction that, most folks are saying, oh, rates are, the Feds are going to drop their rate. That's really going to help. And like even last week's show, no, the last, 3 times the Feds did a rate drop, actually mortgage rates went up. And so it's super important for them to understand that. I want to read, I want to sidebar really fast. You made a comment that the Feds control, car interest rate levels. All right, which is 100%. You said, yeah, and then you said, hey, in fact, if you buy a car before the end of the year, which is a great time to buy a car, unless, would you agree?
Buying a house.
Unless you're going to buy a house.
Correct.
In fact, that's probably the number one killer for people when they buy a house. Would you agree?
For sure.
Yeah. Yeah. What people don't understand, in fact, tell them why. Let's say that I'm going to give you an example. Let's say somebody makes, 10,000. We're just going to use round numbers. Somebody makes $10,000 a month, okay?
Mm-hmm.
And they have $1,000 car payment, $1,000 a month car payment. Mm-hmm. Okay. You as a loan officer, when you look at this, okay, and let's say that they have a recurring $500 a month credit card. So we have $1,000 a month car payment. We have a $500 a month credit card payment, and I make $10,000 a month. What does that do to their buying power versus not having either of those two?
So $10,000 typical qualifying, you qualify for 50%. Let's say that 10,000 is your gross income, not your net income. So the way we look at it, you qualify for around 50% of that. Some programs are around 40%, but most of the time you get in for 50. So you qualify for an overall debt package of $5,000. Okay, 50% of 10,000 is 5,000. So, but we have to take off all your payments that come up on your credit card, or excuse me, on your credit report. We have to take all those off. We don't have to take off utilities and stuff that's not on your credit report. But if it's on your credit report, a car loan, 100, 500 in other debt, let's say it's 1,500, like you said, that's going to drop your qualifying from $5,000 to $3,500. So to give you an example, I was just calculating what that $1,000, let's use the $1,000, what that equates to in a mortgage reduction. Oops. It's about $150,000. So that $1,000, you didn't have it, buys you $150,000 more house.
Right. And people just, they don't get that, because, oh, look at this. I can buy a car, zero interest, or I got this great deal on this car, or look, I can go buy, new furniture or new something. Hey, it's zero down, right? Or zero interest for 12 months. But people don't look at, how immediate, how direct that pulls away from what you can purchase for a home. In fact, cars being the number one killer of house payments, because normally the payments are, they're relatively high. Yeah. So, all right, well, fair enough. So, Dan, part of the show, and people are trying to understand, oh my gosh, why do rates go up and down so much every day? And why is it that like a year ago, uh, we were actually a little bit lower rate than where we're at today. But if we just go back, 60 days, we were 1.2% lower than what we were year over year. Why does this happen?
Well, it's just like saying, why do stocks go up and down? I mean, it's all market driven. But really the main thing that's hurting the mortgage market right now is inflation. So until they see that inflation starts dipping dramatically, the rates are going to stay where they are. And I think, like I said yesterday, there was an indicator that it does look like it's subsiding. They thought it was going to subside faster. That's why a month and a half ago, the rates dropped dramatically, like down to the low sixes for 2 weeks or something like that. And then they popped back up. And that's because, inflation was looking like it was coming down quickly, and then it reversed. So that's the biggest thing. It's all supply and demand and what's going on in the economy. Also, what's going on in just world politics is having an effect on our economy, and it all translates into our mortgage rates and the stock market. So it's all kind of symbiotic. But the main indicator, like I've said a couple times, is inflation. So as soon as inflation starts getting curbed and the unemployment starts, employment is another thing. The unemployment rate is so low that they want to slow down the economy, and that's the reason that they've held off on lowering the rates, because higher rates slow the economy down. Economy's moving too quickly.
Okay, so when we take a look at this chart, let me blow this up, and you start talking about indicators and whatnot that affect the mortgage rates. And we talk about typically every Wednesday, we're in preparation and for what's going to happen. Can you see the chart that is on the screen right now?
Yeah, it's a little small, but I can see it.
Yeah, so let me see if I can make that a little bigger. How's that? Oh, look at that.
That's
There
better.
we go. There we go. All right. So when we talk about, you said, hey, George, we received, excuse me, we received some really good numbers on Friday. And we talked about inflation. Hey, they improved. And most people are like, well, what are you talking about? And each one of these indicators, when we talk about the stock market, which the stock market, responds to this, right? And when we talk about, are these things scheduled? Is this a predictable thing? And the answer is yes. Talk to them a little bit about when you said, hey, on Wednesday, we didn't get, the best information. As we can see here, we had the Fed interest rate decision, right? And then, of course, that was the 2 stars and moderate, but very important. It doesn't sit on this one. But Friday, you said, hey, we got some better than expected information. Talk to us a little bit about what you see on the screen.
So, Wednesday was the interest rate drop. One thing to talk about is when you see these, the Fed dropping a quarter, that's already kind of built into the market a little bit. So, that was anticipated. So when people are seeing the news, the rate, the Fed's going to decide if they're going to drop a quarter. Most economists think they are. That typically means it's already built into the mortgage rates. It's already built in.
Okay, so I need you to pause that one. I want you to do a little bit deeper dive on that one. When people say, well, what do you mean built in? What does that mean, built in? What are you talking about?
It means that the traders are assuming that the rates are going to drop a quarter. They kind of already know it. And unless it drops more, like if it would have dropped more, like if they did a half instead of a quarter, you would have seen the rates drop. If they would have went to zero, they would have went up even further. The rates if they would have said, yeah, we decided not to drop them. So most of the, analysts out there a week prior, 2 weeks prior, 3 weeks prior, you'll start hearing, oh, we expect them to drop it a quarter. We expect them to drop it a half. That expectation is what really drives the rate prior to that meeting. So typically people hear all the news when it happens. It's already built into the market because it was anticipated a few weeks prior. The only
Because
thing that would change that is if there was a surprise to that, like they did something different than what was anticipated.
Right, because it's on the calendar, and that's what was super important the last time when people said, "Oh, oh yeah, the mortgage drop, was already baked into, into the rates weeks before." And that again, because as you see here, that is their schedule. It's just not random. It's just not like poof. The Feds meet one day, right? It's scheduled, so they are predicting and establishing their risk analysis, because that's what mortgage rates are, based on what the expectation is, what is what is the anticipation of what the Feds or what the reports are going to say, and that again the big investors will move in and out and whatnot. All right, so fair enough, thank you. So basically when we talked about the rates coming down on Friday, so that people understand when these things come out and they have positive incomes, rates do what?
If what happened Friday was the core PC inflation numbers were better than expected, so the rates started inching down, and I think they'll continue that way as long as it stays at that level.
Okay, so as far as predictions for next year, it's the 21st. We've got 10 more days, and then amazingly enough, it's going to be 2025. And we've got a change in administration. We have a change in policies. There's a lot of people that are in the, hey, let's wait and see. There's a lot of optimism. What did they say? 67% of the population is liking the direction and what they're hearing so far, which again has an impact on rates and the stock market, which again controls mortgage rates. What do you expect to happen in 2025? What do you see Q1, Q2 looking at?
Well, if you asked me that in the last video we did, they were saying they were going to drop the rates like 5 times next year. So I think we were talking like, first quarter low 6s, second, third quarter high 5s, and kind of continuing that pace down, maybe even into 2026, going into mid 5s. I don't know if we'll ever see the 3 to 4 range like we saw in the past, but now, with the new and with what the Fed said on Wednesday, they're talking about only dropping it a couple times, and inflation is not coming down as quickly as they thought. So I think, right now we're in that high 6 range, 6.8 range, 6.7. I think first quarter we could maybe get back down to the low 6s, maybe mid to low, and then creep down to the low 6s in the second and third quarter, and then probably hang around there depending on what happens. But maybe about a half point worse than what I thought it would do from the last video, but still trending down and positive for everybody. I mean, when the rate hit 6 1/4, here's one thing I'm sure you saw this, but I saw it in dramatic fashion. When the rate hit 6 1/4, my phone was blowing up with people who had been on the fence looking to buy a house. And all of a sudden it's like, okay, I think we want to, and then it went back up and that all subsided. But it's amazing how much that 0.5% in rate, I think, will drive the market.
Totally agree. The J's on the chart are January's to help people understand, what we look at trend. And I think, you're spot on in a lot of ways because, everybody guesses. Everybody's making a guess as to, what's going to happen. Nobody has that crystal ball that, gives, utter clarity. It's a pretty foggy crystal ball, and we make predictions and we hear them all the time. And when the Feds talk, it does have a significant impact on the market, especially when, the last time they met, and they only meet once every 6 weeks or so. And so the last time they met, oh yeah, we're talking about dropping, 5 rates in 2025. Super optimistic. The market inflation didn't quite do what they expected. Now they're like, well, let me claw some of this back, or I guess let me claw some of this back, and we're only going to change it maybe 2 or 3 times. Well, the industrial investors took that as a very negative comment, and then of course started, again, freaking out with the market. The market crashed, interest rates went up a quarter. Now they're starting to settle back down again. And if they say something totally different, if the market is just doing amazing at the end of Q1, they could very well say, hey, yeah, we're going to start dropping the Fed rate more. And that's a case by case. Is that a fair statement?
Yes, for sure.
Yep. Yeah. So anybody watching, from a month ago, they said, well, you said this. And I said, well, yes. However, everything in life does change. And now we're making that adjustment. And do you think that we'll see the high fives at all in Q1, Q2?
I don't think we'll see it that quickly. We might see it maybe Q2, but we might not even see it at all next year. I mean, there's a chance, but I think we're going to be in the low sixes. And I kind of looked at a few rate forecasts that came out recently, and it's kind of that in that range for most of the the main ones are like Wells Fargo does a forecast, Fannie does a forecast, Freddie does a forecast, and the Mortgage Bankers Association does a forecast, and most of them are in that low 6 range for the year next year,
right?
Which is a little higher than prior to a month ago.
Yeah, but even still, so for the listeners out there right now, the low 6s, is that still a really good rate historically?
It is a good rate. It's a very good rate. The problem that we have is affordability, but there's ways to combat that a little bit. But yeah, the rates being where they are now, everyone's used to these rates from a couple of years ago, and it just seems so high. But historically, they are in a good range. Low 6s are in a good range.
Right.
And with some of the creative financing stuff that we have going on with like 2-1 buy downs and stuff like that, you can have the affordability of a lower rate for temporarily, and then in a couple of years when rates are in a better state, you can refinance out of it. I'm sure we've talked about that.
Right there. Yeah. There was a comment on that somebody had made, and if I had my comments open, which I don't, I could kind of walk you through that. So I'm just going to paraphrase it here, and then I would like you to respond to the comment regarding 2-1 buy downs. The comment that was made is that he said, yeah, those 2-1 buy downs, that's what created the 2008 debacle, where they offer you this really low rate to begin with, and it goes up, and financially it devastates people, and don't do it because 2-1 buy downs are just they're going to cause the next collapse. Give us a little bit of insight. Give us really, what is a 2-1 buy down? How does it benefit people? And is it the same? Because that was the thing that I just remembered that was included. And that's what differentiates this. Is it the same as an ARM, an adjustable rate mortgage? What an ARM is? And they're saying, hey, it's just like an ARM. And that's what a 2-1 buy down. It's just like an ARM, and it's going to create a financial crisis for future buyers. And loan officers and banks are trying to take advantage of borrowers. Please tell us the difference between the two.
Dramatic differences. Number one, it is not an adjustable rate mortgage. It is a fixed rate mortgage. You're just getting a subsidy for 2 years. You're receiving a lower rate it sounds like an ARM, but it's not. You're receiving a subsidy. The seller pays it. It's basically the cost of the savings of that interest. Let's use numbers. So if you have a 7% rate right now, and you can do a 2-1 buy down, you're going to be at 5%. That's your rate for the first year. Your next rate for the second year is going to be 6, and then year 3 through 30 is going to be 7. Okay, so that's a fixed rate from that point on. I mean, it's fixed for the entire time, but the reality is the payment's just being subsidized for the first 2 years. If you pay off that loan a year in, whatever subsidy is left over, you receive towards your principal. So you don't lose that money. So a lot of people, that did a 2-1 buy down a year ago, if they refi today, for some reason, when the rates came down, I refied somebody when the rates were dropped, and they got that subsidy back, the 1 year of subsidy they hadn't used. Number two is the qualify. Go ahead.
Real quick. I want to make sure people understand when you use the term subsidy, the translation that equals prepaid interest. You prepaid the interest between the difference of your true fixed rate versus the buy down rate. You're prepaying that interest, sits in an account. So if you cash it out early, you still have that money to apply to a principal.
That's right. It gets applied to your principal. The seller pays a chunk of money up front, and just like you said, it sits kind of like a savings account on the side of your loan. They draw from it to pay a portion of your payment, of your fixed rate payment. The other piece of it is qualifying. We're qualifying you on the 7% in that example. We're qualifying you on the final rate, and you're going to have a very good awareness of where that payment's going. You're going to see a schedule. This year it's going to be this, then it's going to go up to this, then it's going to go to this, and it's a very clear disclosure you have to review like a few times and sign, so you know what you're getting yourself into. Those ARMs, you didn't know where they were going. We qualified you at the start rate on occasion, so you're qualifying at that first year payment. Then all of a sudden it goes up, and it can go up more than a fixed amount. It can go up whatever. And a lot of them were what they call negative amortization loans, which were the payment would stay stable for you. That was the selling point, but the rate would go up. So you go into a negative am situation where you're actually adding principal to your loan every month instead of paying it down. And then that's what really caused a lot of problems, because people were going negative, and then all of a sudden the value started going down, equity went away, and then all of a sudden you're underwater, and then everybody started walking away from homes. That's the difference. We're not doing zero down on these. I mean, there are some down payment assistant programs that you can get in for zero down, but our loan is not zero down. You're just getting a grant that helps you with your down payment. Some of these loans back in 2008, you could do an 80% first and a 20% second, no skin in the game, and you got this drastically low payment because of the way they structured the loan, and then it went negative, and then it just all kind of fell on the top of itself, caused the problem. So I don't see it the same. You know what you're getting yourself into. You have to qualify. You have to have down payment. So it's dramatically different than what happened back in 2008.
Right.
And a lot harder guidelines to qualify too.
I think that's probably, one of the most important elements, and that is, with all of the tightening, whether it was the Dodd-Frank or just the overall, loan parameters that Fannie and Freddie, have put out, and even on portfolio, everything got tighter. And it's super interesting because, there's what did they say? More than 70% of the mortgages nationwide, of people who actually have mortgages, are 4% or less in rate. And that's what gives them a lot of protections versus, commercial, loans, which completely different ballpark, completely different game. If we roll that back, you said that there's no zero down programs. The one exception to that would be VA.
VA does zero down, and I guess what I should talk further about that. We were doing zero down loans for people on a stated income basis, and so
back then,
not only was it zero down, people could, if they're especially self-employed. You didn't have to be self-employed. You could say, "Oh, I make 10,000." Well, maybe you only make 8. We didn't have to check, and so you have good credit. You tell us how much you make. You make 10,000. That works. Let's go. And then all of a sudden it just imploded on itself. And some loan officers out there took big advantage of that, and they were fraudulent at the same time because it was built, those programs made it easy to be fraudulent. And so Dodd-Frank, like you mentioned, is the law that they passed after all that made it much harder to do those types of loans. We have to have way higher credit standards, way higher ratio standards. There's really no stated income left. You can't find a stated income loan. There also are alternative loans out there, which I think we might be talking about, but they all require big down payments, and there's still underwriting guidelines to them. But if you did a loan in 06 versus, I have a lot of people that come to me and the last loan they did was in 06, and then they come to me now and like, God, this is so much harder to get a loan. Like, right. Yep, it is harder because there was no rules back then. They put rules in place, that protection rules.
Yeah, totally agree. So let's rewind just to make sure that we just bring utter clarity to the difference between a 2-1 buy down and an ARM. The 2-1 buy down is a fixed rate, and the ARM adjusts. Say that we have a 5 and, well, they call it a 5 and 6 now. It used to be 5 and 1, but 5 and 6. It's going to be fixed for that first 5 years, and then it adjusts every 6 months after that.
Right.
2-1 buy down, really at the end of the day, is fixed for the entire 30 years. It's just because you're prepaying the interest for the first 2 years, you're buying down that rate. Prepaid interest that sits in that little savings account, it just allows people to get in at a better rate today based on what? That their future income will be higher, that their future outlook will be better. Why would they do it?
Well, it's if you want to have a lower payment for 2 years, we qualify you at the 3rd year payment. So if you think you're going to get a bunch of raises, that's a benefit. And the seller pays that subsidy or pays that prepaid interest that you mentioned. That has to be paid by the seller in most cases. And so the seller pays it, and you're being qualified on that final rate and payment in the 3rd year. But the reason people would do it is, they need they want to have a more comfortable payment in the beginning. And the idea is that if you do a loan at 7% and you do a 2-1 buy down that's at 5, maybe in 1 year from now the rates are dropped down to 6%. Well, your payment rate just went up to 6. We can refi you to that 6 and keep you at 6, so you never see the 7. And that's very likely to happen, very likely. And if it doesn't happen, you go to 7 and you're good. You're qualified, and that's coming. But it's a good strategy to have a lower payment just for your own cash flow comfort level.
Sure. So we talk about a couple of things. So I want to discuss 2 things here real quick. When you say the seller pays it, so a lot of folks, right? A lot of folks are taking a look at when they say, hey, what's going on with, this 2-1 buy down, and then all of a sudden, poof, we see this, right? Where we talk about, builders, hey, only builders can offer a 2-1 buy down, and that's select to them. Can any seller, if I was selling my house today, could I offer a buyer a 2-1 buy down incentive?
Absolutely.
As a seller, I'm not a builder. Well, I am a builder, but in this case, I'm not a builder, and you're saying I can offer this down and do something similar to this.
You can do the exact same thing. So they have a couple in your marketing piece here. They have a couple things. Number one, they're buying it down on a permanent basis to 5.87, like the 3.875. They're buying it down to 5.875 on a permanent basis. So they're paying cost. There's a cost to that, and then they're also doing a 2-1 buy down on top of it. So that's probably like 4 or 5% seller concession right there. So you could do that as a seller if you wanted to. You could be as aggressive as they are. That's very aggressive. And do that. And then they're doing
most folks look at the cost of a 2-1 buy down, and I'm just going to grab some numbers that I think I remember, between 16 and probably 24,000, depending on loan balance. That is
2.6% of the loan balance. So
2.6%.
Yeah, is a typical amount. It's a little deeper calculation, but that's about what it translates to most of the time. So $1 million home is going to cost, if you sell $1 million home, it's not 26,000 because it's on the loan amount. So if they do 20% down, it's 2.6 of 800. But let's say you're selling a $1.25 million house and they do $1 million loan. It's going to cost the seller $26,000 for that 2-1 buy down, approximately.
Okay. So simple enough, that anybody can ask this. It's just going to depend on net, proceeds to the seller, flexibility of the seller, excuse me, and working through basically, having your agent, communicate with, or if you're just communicating directly with the seller, working and showing them how those numbers work and how it incentivizes you, which then rolls into the second conversation. That is, one of the reasons people would do this is to help to mitigate kind of payment shock. Right. Most folks, in fact, one of the things that we tell folks is hey, listen, get your pre-approval. And let's say that your payment based on your pre-approval and your down payment is, let's say it's $8,000 a month. And what we tell folks is, hey, take your rent, set that aside, put that into an account, but you pull your rent up, but you pull the remainder. So let's say you're paying $3,000 a month. Your payment's going to be $5,000. Take $5,000, put it into your savings account. You're going to need it anyway. But start to acclimate to that payment, or what we call payment shock. This would help mitigate that in some circumstances. Is that right? A fair statement?
Yeah, and it does help, like if people know they're getting promotions down the road or raises down the road. But again, we are very clear with what that payment's going to. And I always tell clients, like, be prepared for that payment in year 3. There's no guarantee that rate's going to go down, but and the other thing, like some people might have a car loan, like we talked about before, it's going to be paid off in 2 years. Well, maybe that $1,000 is going to eventually go away. Well, then now when that mortgage payment's going up, your car payment goes away and they're offsetting. So that's another benefit, I guess.
Sure. Debt mitigation and whatnot. At what point, this is a loaded baity question for you. At what point does a car payment not get included in your monthly debt calculations?
If it has 6 months left on it.
Okay.
So
can somebody, if they owe more than 6 months, let's say they owe 12 months, okay, can they pay towards the principal balance and get it to 6 months and have that not included in their debt?
You can, but a lot of it depends on the loan program. Some of them will want you to do that before they'll want to see it on the credit report prior to me pulling it. So if you know that's something you want to do, you might want to, before you have your credit pulled, pay it down to that 6-month level so that it shows up.
So what you're saying is somebody should make application long before they look at actually purchasing a home if they're interested in saving money and getting themselves in the best position to buy a home. Is that what you're saying?
Absolutely. Well, and I also say, I always like to throw this in there because the first question I get from people is, well, I don't want my credit pulled. We only do a soft pull credit, which I can give you a lot of information on and strategy and advice on a soft pull credit. I don't need to do a hard pull credit. So that's, you're not taking any risks by, getting pre-approved via a soft pull credit report. I can't give you a final approval or an underwritten approval without a full hard pull, but I can give you a pre-approval and write you a letter and tell you everything you need to know without your getting an inquiry and hurting your credit.
Which, that's absolutely correct. We hear it all the time that, oh, I don't want to have them pull my credit because it's going to drop my score. And I'm like, no, you need to do a soft pull. In fact, we tell them, hey, listen, reach out, only tell them soft pull only. And which, eases their mind because, how important is credit score to mortgage rates?
It's more and more important because, so the credit score is crucial in not only approval, but in your pricing. And it used to be that anything over a 680 score was all the same rate and fee structure. And in the last 5 or 7 years, they've dialed that down and created these smaller buckets. So if you have a 780 score versus a 760 score, you're going to get a better rate. It's very slight. 740, even better. It's 20-point increments. It used to be like 50, 60-point increments, but
Okay.
they've really made it, they want they give a value to people who have really, really strong credit, a bit better pricing. So having that better credit score is crucial for pricing and for qualification. I can also tell you on a soft pull credit, let's say I pull that soft pull, it's going to tell me your score is 699. And it'll also tell me to get it to 700, here's what you need to do, or 720, which is nice to know that way ahead of time because you can take a couple small steps. Sometimes it's paying an extra $100 off a credit card, and it'll bump you up to that next 20-point increment from 699 to 7. You'll get better pricing. So it's a value.
It's a big deal in in many of our home prices, on the east side, where most of that starts north of 900,000. Mm-hmm. And so once we start getting up there, those small increments make a big difference.
Mm-hmm. For sure.
All right. Yep. So let's circle back around to, we've got some, mortgage programs over, obviously after 2008, a lot of programs went away. Again, everything tightened up. That pendulum swung the other way, and through time and because you guys have to quote unquote stress test. There's that calculation, that stress test of what people can afford, or the affordability stress. I forgot what they call it. Anyway, they stress test them, and as they have figured out that more and more people are becoming, better managers of their money for the most part, and with these tools, that pendulum's come back more to center with additional options, loan options, especially if you sit outside of that box of, conventional financing. And you had sent over some information as kind of a bullet point. Let me pull that up really quick.
Yeah. So while you're doing that, when the 2008 thing, we talked about that earlier, happened, which is basically the mortgage crash. There was a overcorrection on, guidelines. It was dramatic. They made it dramatically harder to qualify right after that, and for good reason. They kind of had to they had to like pull way back and say, okay, let's start fresh and go back to the basics. You got to have a big down payment. You got to have good credit, and you got to show that you can make the payment through your employment or other means. Well, they kind of went a little far on it, and there are some people out there who might kind of check two of those three boxes. The three boxes are down payment, debt to income ratio, and credit. Those are the main three things we look at for qualifying. Well, if you check two of those boxes in a dramatic fashion, and one of them you're just outside the box, you were declined basically. I mean, you could have 75% down payment but not show any income and have good credit, and you'd be declined. Well, that doesn't make sense. Like, you should get a loan. But that's what happened right after the 2008 crash. So since that time, there's been some programs that have come out slowly that have loosened up a little bit, but they still require, what I like to tell people is, you got to have, two, kind of like two strikes, you're out. If you have one strike on those three out things, I can probably get you a loan. If you have two strikes, it's a little harder. 3 strikes, you're out. There's no way. So like for these programs we have, like the bank statement loan here, these are just alternative programs. If you don't show a lot of income on your tax return, but you show cash flow on your bank statement that's consistent, we can use that as income, the bank statement income. So we'll look at a 6-month, year, or 2-year bank statements. And if you show good cash flow on those bank statements, we'll use that as your income. You still have to have good credit, and you still have to have a decent down payment on that program. Sometimes you have to have a little bit more of a down payment on these programs to offset the risk of the alternative income source. 1099, that's basically, you have a 1099 you receive every year, but you have a lot of it. You do a lot of write-offs, so that when you see your tax return, You have $100,000 in 1099, but your bottom line is 20,000. Well, we have a program that allows us just to look at the 1099. Again, you have to have a decent down payment and you have to have good credit or decent credit. Investor cash flow, that is, if you want to buy an investment property, we will look at just the investment, let's say it's a rental property, we'll look at the rental income on that property. And if your payment is covering most of it or a portion of it, there's a calculation we have to do. We will allow that to be your income. Again, you still have to have a decent down payment and good credit. Asset qualifier, if you have a large amount of assets in your portfolio, we have a way to qualify you, knowing that, okay, this guy's got $2 million in assets. We're going to use that. And, if you don't make a lot of money monthly, but you have good credit and a good down payment, we'll use your assets as your income. Knowing that if you ever had a problem, you could just pay off the loan if you wanted to, or make the payments using your assets. Full doc, what that is basically the normal program programs that are out there, but you just barely are outside the guidelines and you don't qualify. Maybe your ratios are at 55 on a jumbo loan instead of 50 or 43. Or jumbo loans usually require 43 ratio. Maybe your ratios are 55. This program will go to 55 on this. So you're just outside that guideline and you would qualify for that. Again, bigger down payment, good credit. Foreign national, we have that program. If foreign nationals are looking to buy, don't show income here. We have that program, allows foreign nationals to buy property here. ITIN is you don't have a social security. P&L is we're using just your P&L. We're not looking at tax returns, just a profit and loss. Has to be professionally prepared, but it might not match up with your tax return for whatever reason. And then written verification of employment. So we can do that as well. That was a quick overview. Lightning round.
So, in other words, there's a lot of different opportunities out there for our non-traditional buyers that they can look at. The takeaway is many times they have higher interest rates because it's based on risk. Many times there's maybe more down payment that is required.
Not too much more, but not like most of it's, I think 15% down is the minimum on most of these programs. On the investor stuff, it's like 20 to 25. So it's, you can't get in from 5% down or 10% down on these. You have to be 15% down or more. But it's also good for people who maybe I get a lot of people who call me that have been self-employed. They show really good money, but they haven't been self-employed they don't have 2 years full self-employment. Like that's a good example. But in 6 months or when they file their 24 tax return, now they qualify for a normal loan, but they want to buy their dream house that just popped up on the market. And how do you buy it? Well, you buy it using one of these alternative programs. And then as soon as you file your tax return, maybe 6 months goes by, we refinance you down to a normal loan. So it's sometimes just a transient type loan where it's a Band-Aid loan to get you to another point in time. Most people might just want to wait until they have till they get to that point. But some people, hey, I just found my dream house. I've been looking in this neighborhood. It's the perfect house for me. And if we can get this one, it checks all the boxes for our needs. And we'll take a higher rate for 6 months. And then I'll show you my tax return and we'll drop it down at that point. So that happens a lot. Stuff like that when you have a time issue.
Sure. So I guess one of the things that people need to look at, how much in advance of purchasing a home would you recommend starting the financial pre-approval type of process so that they can put themselves in the best position for a purchase?
I think when you start even thinking about buying a house, or even if it's a year away, I think it's a good idea to get prepared. I'm happy to do a consultation, do that soft pull credit. The application online is probably take you 10 or 15 minutes and just do a quick consultation. And I can say, hey, you're ready to, if you want to buy now, you can. Here's what the numbers look like. Or maybe it's, you only qualify for X, but you want to qualify for 2X, double that amount. Well, here's what you need to do to make that happen. And I can give you some strategies on how to get to the point you want to. Even if it's a year away, I'm happy to follow you through on that journey with you.
Right on. And what sage advice would you recommend to buyers today as they're considering making a home purchase, and getting ready for really next year?
I mean, do the consultation, talk to a lender, do the pre-approval, have your credit pulled, make sure you know what you're getting yourself into, make sure you know what the numbers all translate. I had a consultation with a client about a week ago, and he just didn't realize the amount of money he had to come in with for what he was looking to do. And when I kind of detailed that out, he's like, wait a second, that doesn't fit. And I said, well, here's some strategies to either put less down, buy less price. There's all kinds of options to getting gifts from a relative temporarily. There's the 2-1 buy down thing that might bridge a gap that you need. There's lots of ways that are, to get to where you want to be. But I think, getting ahead of it's super important.
Agreed. One more question before we button up your side of things and move on to the market update. There's a lot of folks out there that get the benefit of RSUs, right?
Mm-hmm.
And for folks that are out there, explain kind of the guidelines of when can an RSU be used, how are they calculated into your benefit, and how, in the perspective of a lender, what is the value? How does it look in the eyes? Because hey, we received this little bonus of a stock bonus. What can I do with it? How does the bank look at it?
So the bank is going to want to see a 2-year average from when you started receiving the RSUs. So a lot of companies will have an onboarding package. You start January 1 and you're going to receive, a chunk of stocks as like incentive to onboard. And then you're not going to receive your RSU stocks until maybe 6 months later. So we start looking at it after that 6 months. That onboarding part doesn't count. So we start looking at from when you receive the first vesting or the first stock award, and then we have to have a 2-year history of that. And then we also look at the vesting and it'll most of the time we can see what will vest going forward. And we have some calculations we do that give us an average of what we think you'll receive, and we use a conservative 52-week average on the stock. So like, I know Microsoft stock is way higher than its 52-week average right now. Most of them are, but we have to use a lower number, so it might be lower than what you expect as far as the stock income, the stock price we have to use. And then we use a 2-year average. So there is a couple exceptions to this. One is our alternative programs. It's one of those outside the box situations that we could probably use RSUs. Again, higher rate, bigger down payment, possibly, but we could possibly use those RSUs sooner. Also, Amazon, I don't know why this is, but Amazon has a special feature where we can use the onboarding package, but it's only Amazon. I don't know why they have, that's a Freddie Mac exception that we have, that allows Amazon employees to use their onboarding as part of their average. I don't know why they haven't expanded that to other companies, but it's only an Amazon feature. And every company does it differently. Every company does their RSUs differently. So there's some documentation we have to gather, and we have to do some analysis and calculating, and then we can see if we can use it.
Okay. All right. So it's not a straight across the board, super simple. There's there's a few steps, a few measures that are looked at specifically as to how the lender is going to value that RSU.
Right.
That's a yes. Yes. Okay. All right.
Yep.
Fair enough.
Correct.
Okay. Anything else that you would like to tell the people on our day? Basically, this will be our second to the last show of the year. Any parting words you would like to tell folks? Anything coming up you want them to know about?
Just have a good holiday, and I think the market's still good. I think I think next year is going to be really good in the real estate market. I think prices are going to, continue to go up, not dramatically, but they'll go up. So I think it's a good time to buy, and buy now, refi later. I think it's a good idea, and just have a great holiday and happy New Year to everyone. Just grateful for what we have.
Right on. Do appreciate it, Dan. In the meantime, all the best to you and your family. Have a very Merry Christmas. I know I'll be chatting with you before the new year. So in the meantime, thank you for coming on and taking time to explain a lot more detail about what the expectations are, what people need to do to best prepare, and then of course explaining why the heck is it when the Feds drop their rates, whoop, mortgages have gone up. Thank you for joining us today.
Thank you, George. Good seeing you. I'll talk soon.
All right, buddy. Take care.
All right. Bye.
Bye-bye. Okay, so let's hit the second part of the show here. We'll be breaking this up into different shorts and whatnot. And make it a little bit more palatable. I know these are this is a little bit longer of a show, and but hopefully you're going to find some really great value. Let's go on to the metrics. And let's talk a little bit about what is going to be going on. It's funny, one of the people not in our state did a, hey, is Seattle housing market finally going to crash and whatnot? And after he went through and started comparing the east side to the middle of the state, which are wheat fields, which he, unless you're familiar with the state, you wouldn't know. And he's like, yeah, look at the dichotomy between the two. And I'm like, yeah, that's a wheat field over there. There's not much that happens over there. Anyway, it was super funny. His prediction is that in 2025, we're going to see a 3% reduction in housing values. Not sure I 100% agree with that. He's got some interesting tools, and of course, he's selling a subscription and whatnot. So not that takes away from his presentation, but to me, kind of takes away. Because he needs to say whatever it needs to incentivize people to come in and look at it. But I guess on the big scheme of things, I kind of disagree with him, and some of that is going to be based on a couple of things. One, what do mortgage interest rates totally do? And then when we compare the consistent metrics that we look at each and every week. And only look at residential, not looking at condos, manufactured homes, and whatnot that can, I would say, skew some of the actual numbers of volume. Obviously, we do significantly more volume of single family homes than we would ever do of condos, and so that can have an impact on those numbers. He may or may not realize that. But anyway, so our numbers are residential only. So let's jump into something here really quick. As you know, we went through what the heck happened with the rates. We went through that with Dan, pretty much clear. When we take a look at some of our headlines, and again, remember, some of these numbers, they're still talking about November, but the headlines, highest existing home sales since March. And that is a trend that we have seen consistently. The bottom left, builder confidence remains low, but sales expectations, are increasing. And that's super important to keep in mind as we go through the metrics here with some of the incentives that, are going to be harder for these builders to maintain, as we start seeing, interest rates do whatever they're going to do, because at some point in time, they need to make sure that they're making their profit, because they're writing down all of their mortgage benefit to incentivize people from going from resale over to, back to new construction because our inventory bumped up. Not that that's a negative thing. We're still only about 50% of the inventory of where we were at. I think the gentleman that was watching said that our inventory was higher than 2019, and that is a false statement. But I should say it's false when we take a look at residential. If you include everything in the kitchen sink, oh, sure, it does. But that's not a metric that is consistent that we follow. So getting back to this, you can see that the mortgage rates came down just a tad bit on the upper right-hand corner. And then, of course, there's free calculators. It's awesome to see people use them. There's no login. There's nothing that you need to, that you're beholden to with the calculators. There's a couple of different kinds, including, rent versus own, things like that. Just go enjoy the calculators. If there's any feedback, let us know so we can, continue to improve them. No big deal. The key is, to get you information, get you fun information, kind of like this. We've been breaking down super short videos, are about 27 seconds long, diving into more specific areas and giving you a kind of a deeper dive in certain areas, which is no big deal. It's actually a lot more fun, and it allows you guys to take a look at what is happening in real time. Anyway, and of course, we're going to add the just for fun. What were the most expensive homes that sold? Because that's what is that? Their old show, the lifestyles of the rich and famous. That was on years ago. But anyway, it's kind of fun, just fun to look at again because we like to have fun. Anyway, nonetheless, when we pop back to this one again, when we talk about rates, right? Each of the dips was just before the Fed rate. The spikes are where the Feds did their rate drop. No, it's not very exciting. Yes, the Feds do affect it. Even when we look at Freddie, excuse me, we were doing amazingly well. And then, of course, now we're about 0.05 higher in rate than where we were at last year at this time. Now, that's not a like, oh my gosh, the sky is falling. Remember last year in October, that's when we started to see the mortgage rates starting to come down, and they really benefited in November, December. And if you remember earlier shows, we talked about how, hey, as we get closer to the end of the year, how are those two really going to balance out? Because we came down significantly and saw that benefit. But at the same time, during that timeline, the Feds never reduced their rate. They just stand, they, as we say, stand fast, right? They stood fast during that time, and that's why we saw much lower rates, and we didn't see the impacts that we've seen on, do recently. Nonetheless, still moving on. So as we take a look at the Fed rate, you can see, or Freddie's rate here, you can see that we had a small uptick both in the 30-year and the 15-year. Not unexpected at all. And they do have a kind of a lag. And I think that we are going to start to see those rates start to ease off between now, the end of the year, and carry over into January, subject to, again, what you saw on the calendar of events, which is a known calendar, and we update you, say, hey, Thursday, expect this. Hey, Wednesday, this is what we're going to see. And rates, because they're publicly traded on the stock market, adjust, based on that. If Jerome Powell says, who's the Fed chair, says something that, that the market doesn't like he did on Wednesday, well, it has that adverse effect. And then it takes a little bit of time to heal, and then we go from there. So as we roll over, I meant to have Dan address this one. Remember, January, we will have our new mortgage balances. Again, that's based on average sale prices and earnings and whatnot. And so this is a benefit. It helps each area to stay consistent with what minimum balances are based on, well, again, income and values. Super simple, and it's just one of those things that translates into what people can do as far as affordability and whatnot. So as we take a look at this, you can see, hey, yeah, we're down a little bit from where we were at last week as far as average days on market. Really not much of a change at all, as far as time on market. When we look at the running 7-day average of the Northwest MLS, look at this. A little bit more than I expected. I expected this to be more in the 200s, but we had 317 homes that came on market, right? Well, golly gee willikers, you have 881 homes that went pending. So if you're thinking that, oh, real estate market is a ghost town, nothing's happening, you're wrong. There's a lot that is actually happening in that industry. We're still seeing a number of showings. We're still seeing homes going off market. And when we take a look at even on the price reductions and whatnot, we're seeing similar activity. The most important thing, look, there's 2 homes going off market or going pending for every single home that's coming on market right now. That's not new. Other than a couple of weeks during the year, which was in October, that has been a consistent pattern. Sure, we had a number of homes that came on that were adding inventory to what we were at, which was getting us back up to, the 50% of where we were at pre-pandemic, or basically 2019. When we take a look at those numbers, we're still below those numbers, but yet our prices are still going up, which translates into, yes, an affordability issue, right? So the key thing is, when we take a look at even our sales prices, the J on this one stands for January. As you can see, there's the normal dip in sales prices, the highs or the humps. That is typically your May, June, which is the post spring, and that's where we see, because everything's a 30-day lag, that's where we see the higher sales. And you can see we're up about 8.9% right now over last year. The only other time that it was that competitive, which was back in 2022, and that's when interest rates, heck, they were, in the 3s, 4, well, really the 4s, and then started to hit into the higher 5s, and then the Fed stopped buying mortgage-backed securities, started putting the mortgage-backed securities that they were buying back on the market, flooded the market, rates took an almost vertical climb. Supply and demand. That's pretty straightforward, right? Here's the key thing. If you don't mind, if you wouldn't mind at all, hey man, give us a thumbs up. Let us know that you like what you're hearing. It would be awesome if you subscribed. It just helps the channel, our hard work and everything that we do to keep you guys updated every single week. That would be super awesome. But at the very least, and then ask your questions. We do get great questions. We do respond to them all. And sometimes we'll do a private video for you so that we can do a deeper dive and answer your question or whatnot. So remember to do that. So let's delve into what we're talking about as far as velocity, or not velocity, but average days on market. And when we talk about sold, so our days on market, we actually just went through. So our average for list sales price is down from last week by $9,000. It's still a little bit better than anticipated, but we're down just a tad bit of where we were at last year. Down definitely where we were at last week. We're down $10,000 average sales price of where we were at last week, but we're up 7.3% for the same month year over year. And then, of course, year to date, we're up 8.4%, but nothing as far as the actual sales price year over year. Not much has really changed. It's pretty much, where we were at last year, just a little bit higher, only about 7%. All right. So if we come back here, hang on a second, let's hit there's my bigger numbers for you. Giving you an idea of where we are at both year over year and year to date. When we talk about velocity, which is what I was going to talk about, let's blow that one up now. Again, we're still considered a balanced market. It doesn't really lean towards the sellers. It really doesn't lean towards the buyers. And that's actually super important, because if we actually had the traditional 4 to 6 months is what they used to say was a balanced market as far as inventory. So if I have a bucket and all the real estate for sale from all agents get put into this bucket, and I put a lid on it, they're saying that a balanced market, we should have 4 to 6 months of this inventory to sell, to be a balanced market. Well, we haven't seen that in over 10 years. And so really at the end of the day, 2 to 3 months is probably the balance. And that is very consistent with what we're seeing here as far as number of homes coming on, number of homes that are going off, the static inventory that we cycle through, which also includes canceled, expired, blah, blah, blah. Anyway, we're kind of right at that balanced market. So when we take a look at year to date, volume of sales, we're up 5.7%. Number of pended year to date is up 6.2%. And that is a big deal because it still shows that we are trending in an upward trend. Even when we take a look at the same month of December, year over year, we're up 500 homes based on sales. We've had 500 more sold, in other words, and we've had 500 more pended, or basically up 0.25%. As far as, or 25%, I should say, as far as actual increased volume. Why? Rates, inventory, people's desires to fix that, that monthly expense, to control that for the future. Super important as people are doing their budgeting and adding stability to their life. Sure, in a lot of areas, renting a home is cheaper, but does not afford you that stability because, well, a property can be sold at any time. Rents go up historically, as they do here. And so if you want to, basically kind of give that fixed and then enter the market and then start paying yourself, creating that overtime interest rate or equity, I know I can spit it out, then that gives you that security, that value, right? Anyway, moving on. As we take a look at the new construction, super easy. We went through that chart showing the different incentives. And again, right now, hands down, and as you can see with our improved numbers with new construction, now's the best time to get the best deal from a builder. Not so much in price, but in incentives and buy downs and things like that, and extra credits. And there's when you're out, hey, understand there are ways to negotiate more than what a builder is trying to offer. If you're just going to the builder direct, I guarantee you are leaving dollars on the table. I guarantee it. There are tricks and shadow inventory that they have that we know that they're holding that you can capitalize on. Lot placement and things like that, and getting that lot premium reduced. There's ways of accomplishing that if an agent does not work with a builder consistently to know how to have that conversation, more importantly, to know how to get you the best pricing, not just what they say, hey, here's what you have available, you're probably leaving a couple of $10,000 on the table. Just saying. All right. So when we come over, we start taking a look at the actual pricing. So funny enough, when we take a look at average days on as far as sales price, and we take a look at an average of what has sold. So our list price has pretty much stayed the same from what it was week over week. Both numbers are actually up from where they were at last year at this time, year to date. When we take a look at the month of December, hey, look, the sales price is up 10%. And that is that is actually impressive because, and you might say, George, well, why? And I said, well, because in Marysville, they have two massive projects up there with homes that are significantly less than what we have seen. And it did impact the value. But based on what is sold, you can see that our numbers actually have started to recover from that on the average price sold, which means that we're seeing more on the higher end neighborhood selling than we are in the lower end, which is saying that, hey, builders are being definitely more purposeful and definitely more proactive in what they're doing. And so that when we take a look at, the actual velocity of what's going on, listen, yeah, their pendants are down. Sales are up, not even 1%, just 0.3%, and it's just up a little bit, not much, but just a little bit. But we're only 161 homes off now of where we were at before, and we were about 1,000 homes before, not quite that high, but a significant number of homes before as far as year to date. But when you take a look at our, month over month for December, look at that, man. They're both of their numbers as far as pending and sold actually have gone up, and that is just a testament to the incentives and the end of year and what builders are willing to offer. So keep that in mind as you're comparing that to existing homes, typically in better neighborhoods, closer to work, bigger homes, bigger yards. You don't reach out and grab the salt shaker from the house next door. Just saying. Anyway, so bank-owned homes. Bank-owned homes are still lagging. Had a great conversation with Kari Olson, who's with I just absolutely drew a blank. I believe it's Mid-Mountain Credit Union. Anyway, talking about different things. We do work with a number of credit unions in the area. And if you are pondering between a credit union versus a bank, credit unions treat their members so well. It is very personable. I highly recommend them for a lot of different reasons. And if you ever get into a sticky wicket, as my old business partner Brian Graves used to say, then they're there, and they are definitely there to help. The big box banks, you're just a number. And that's all there is, and that's all there ever will be. And that's okay. I mean, they cater to the volume. Credit unions cater to the people. That's why it's a community bank. Qualstar Credit Union is one of my all-time favorites, along with Boeing Employees Credit Union. And there are others. Those are ones that most of our clients work with. And so we have a special relationship there. This is it. Now, funny enough, not all of those homes, those little green dots that you see, are bank owned. There are 10 that are not bank owned. But as you can see, that's nothing. That is peanuts. There's a total of 90 quote unquote homes across Washington state. And as you can tell, that's there's just not much available. When we take a look at our actual numbers themselves, it's pretty small. Sales are down. I love the bottom chart center there, which shows for December that homes sold at 102% of list price. Well, that's a big deal because again, banks, they don't need to discount REOs here because we're one of the 5 sweet spots. I think actually we're number 3, and so. Will we continue, through 2025? My answer is yes. Our inventory is still very low. I think we are going to see interest rates starting to come down as we start coming down into the lower 6s. When we hit about 6.25, less than that, we see a big buyer influx of the buyers on the sidelines. And if we don't see a lot of sellers coming out for resales, we're going to continue to draw down that inventory very quickly. So if you have any questions, post them down below. Remember, hit the like button for us. We'd love it if you subscribe so you're alerted. We do a lot of different contacts, and including with vendors. We got a lot of vendors out there saying, finally, yes, come out and we'll do a video, which will be a lot of fun. It'll be very helpful for you guys. In the meantime, have an absolutely beautiful day. Very Merry Christmas to each and every one of you, whether you celebrate Christmas or not. It is a heartfelt thank you and all the best to you and your family. And I will see you on the next video. Take care.